So you got a bit of money, you're looking to invest it in the stock market but don't know what to look for when trying to choose a stock? Stay tuned for my top 5 ways on how to choose a stock that is profitable and will be a successful investment. How's it going, guys? Ryan here, and today I want to share with you what I look for in a company when I'm deciding whether or not to invest in them. If the company doesn't meet these key 5 criteria, then I will not consider them for a long-term investment. So kicking it off with number 1, the first thing that I look for is a low OPEX and a low CAPEX. Now, for those who don't know, OPEX is operational expenditure and CAPEX is capital expenditure. So OPEX is essentially the cost to run, the cost to produce, the operational costs of the company, whereas the capital expenditure is the actual startup costs or the buying of assets in order to make a plant run or to start up the company, buying excavators, buying computers, that sort of thing. So when we're talking about CAPEX, we're looking at companies which are generally a lot younger, they're newer to the market, they need to pay a bit more money to actually get themselves up and running. They might not actually be producing anything or providing a service yet, but they need to buy everything in order to get that in place. When we're talking about OPEX, we're talking about all companies. Even if they're not producing anything at the moment, you've got to look into the future and see, hey, how much is this going to cost to produce and how much money will they need to make in order to cover those costs and be profitable? And when you're looking at companies that are already established, they should already have low operational costs. So if they have high operational costs, especially compared to competitors, then I'd generally tend to steer clear from them. You want to look for those companies where they're ahead of the curve, they're ahead of their competitors, whether they're using, whether it be efficiencies in their supply chain or they're using materials which are a bit cheaper. Anything that essentially reduces the costs but then keeps the profitability and the quality of the products that they're trying to produce or sell high. The main takeaway from this is essentially you want to invest in a company that's low cost, they've optimized their supply chain, or they're looking to have a low cost product being produced, mined, etc., or provide a low cost service. Number 2 on this list is look for a company which is providing quality products, services, or materials to their clients. You don't want to be investing in a company that's providing a subpar service or a low quality resource or material, because at the end of the day that means they're more susceptible to their competition. Someone's going to come along and provide something that's significantly better than them, and as a result the company's going to go out of business because they're going to choose the other company. Now at the same time you need to realize that it needs to be set at a reasonable price point or the market price, and it meets the requirements of the customer while also still maintaining a decent quality. A good example of having a quality product is the mining industry. If you're a miner, you want to be sending material to your clients that's of a high grade. Essentially, this is because it costs a lot less money for them to refine that material, and as a result it reduces the costs on their end as well, and they make more profit at the end of the supply chain. With number 3 on the list, you're coming back to basics and you're looking at what is the supply and what is the demand. So you want to be looking for a company that has a high demand for whatever they're selling, and there needs to be a low supply and a lack of competitors or people who can meet the same standard as those people in the market. First of all, when you're looking at the demand side of things, you need to look at the company and you need to say, okay, what is the product that they are selling? What is the service they are selling? Is it a necessity? If you're going through a boom, that might not necessarily matter as much, but it is crucial in order for that company to sell their products to the clients. The company needs to be existing in an already established market, so there needs to be clients out there who actually want these products. If you're looking at industries where they're not too big and there's not too many people buying the products and services, then you're less likely to be investing in a company which is able to sell their products and make money. Looking at the low supply side of things, you want to be looking at companies which are in markets that aren't already oversaturated with other suppliers. As a result, you'll already have an established market base which will be looking for other people to buy products from, hopefully your company, or you've already got an established base in the market and not too much competition. Then you can also look at the low supply side of things when looking at the resource or the material itself. If it's something that's rare, then people are going to want it, people are going to need it, especially if it's something that's running out in the world. So a beautiful example of this is halloysite and kaolin. It's a product used in fine china, and it is a product that is running out around the world, and there's not many resource deposits that currently exist which provide high quality material for the people who need it. Fourth on the list is, what is the intrinsic value of the company? You want to be looking for a company which is currently undervalued, or there's a large potential for them to grow in the future, and as a result you can see, hey, the company's stock price is X but it's going to be Y moving forward. This is a bit of a harder one to look into, but a great way to understand what the value of a company is to look at the peers in the market, look at their competitors. What are they currently valued at, and what do they have compared to the company you're looking to invest in? That way you may also realize, hey, the company I'm looking at the moment is not actually that profitable, and as a result I should be investing in this other company which does the same thing but 10 times better. Now moving on to number 5, this is a bit different. This is one that's a bit harder to understand. You sort of need to get a character or work out a bit more about the people involved. So number 5 is, you need an experienced management team who are also passionate and also have a vested interest in the company itself. So some things to look for are they experienced in the industry? Have they been around the industry for long? How many years have they worked for? If you're looking at people who have been in the industry for 15, 20 years, then generally they've got a good grasp of what's going on. And also, how long have they been in management or senior roles for? Is this their first time doing it, or are they experienced? Not only does experience come into play, also what are their qualifications, what are their skills, what are the previous jobs that they have done, because that will really put a picture together for you, unless you get to meet them, of what sort of individual and what sort of knowledge they actually have. You also want to look at whether the managers and directors have a vested interest in the company. Have these people essentially pulled money out of their own pockets, bought shares on the market or through other means, and as a result there's a reason they want the company to succeed? So shares on the market, that's a perfect example. If they bought them with their own money, they want the shares to go up or they're losing money, and at the end of the day, if it's going well and the share price increases, then they're making money. If they don't have a vested interest in the company itself, then there's just that little bit lack of a drive there. And these people could quite literally pack up and leave the company at any time, and it's not going to impact them financially at all. And as a result, they'll be less likely to want the company to succeed. So guys, that is all for today. If you found it helpful, please leave a like, leave any comments below of videos you'd like to see. And if you want to keep up with more content, be sure to subscribe. And with that, happy trading, and I'll see you next time.